Hello, class. Welcome to the last three problems from the Chapter 23 sample problems on transfer pricing. Oops, am I in the right one here? Yes, I am. Okay, so for this is problem number 6 that we're starting on of 8. And we've got Jose Martinez of Shakeout, a producer of premium ice cream. They have two divisions, the supplying and processing divisions. And so we're going to be looking at what are the costs here in terms of producing the milk, the main ingredient, which is produced in the processing division. And they're looking at selling this company to a competitor. So the supplying division buys their milk from local farmers for $5 per 10 gallons. Okay, so supplying cost, $5 for 10 gallons. And they incur $1 of variable costs per 10 gallons transported. So variable transport is $1 for 10 gallons. Then the processing division could buy milk of the same quality. So market price is going to be $8 per 10 gallons. Okay. And they're trying to implement a transfer pricing system to incentivize both the supplying and processing division to be more successful. Okay, so the supplying division will get reimbursed for incremental costs of supplying milk to the processing division. Okay, so they'll basically, what they're saying is the variable costs are the incremental costs. So this would be a total of $6 for the incremental costs per 10 gallons. Okay, and the processing division is charged the price that it would have to pay on the open market. Okay. All right, so what is the profit for the supplying division of supplying 10 gallons of milk to the processing division under Jose's transfer pricing system? Okay, so the transfer price here is going to be that $6 cost, and the incremental cost here is also the $6 cost. So we didn't have they're saying if we transfer this at cost, that's the cost that they're getting, $6. So there's no profit being generated here, okay? Because that's the price that it's going out of the supplying division. Okay, now, this system will not incentivize the managers of the supplying division to work hard because no matter what the cost is, they will not have a profit, right? Because it's just being transferred at cost. Okay, so no matter how hard they work, no matter how well they run their division, the profit will always be 0 under this system. Okay, now, in the back of Jose's mind is that one of his larger competitors may be interested in buying only one of the divisions and not his entire company. He's patting himself on the back for choosing the transfer price system since, in his view, it makes the profitability of each of the two divisions look very good. Do you agree with Jose? No, because as in calculated 1 above, the profit for the supplying division is 0 under the transfer pricing system. The profit of the processing division is, let's see here, lower than it would be if the processing division was charged a lower transfer fee. Let's see here. So a lower transfer price than the market price of $8, right? So basically what they're doing is they're taking the $2, they're charging this processing division the market price of $8, but they're only crediting the supplying division for $6. So the medium $2 is just going to what corporate profits or some other accounting shenanigans that he's got going on here. So it's kind of a lose-lose because this is the highest price that they can charge, right? Remember when we were talking in class, we said that the market price is the ceiling, the most that you can charge, and then incremental cost is the floor or the lowest that you should be charging. So they're charging this one, the highest one. They're only crediting this one for the lowest one. So basically everybody is getting a raw deal here. Okay, now for problem number 7, we have Emerge Aeronautics, which sells aircraft and has 2 profit centers, systems and assembly. Systems makes navigation equipment and transfers them to assembly, which then puts together the aircraft for its external sale. Okay, so systems has a capacity of 150 units. And the variable cost is $3 million each. Okay. So that's our variable cost. Okay. Assembly has variable costs equal to $11 million per aircraft. And they receive an order for 7 planes at a price of $22 million each. Okay, sale price. Okay. All right, this is just a repeat of the questions here. Okay, so suppose that systems has no ability to sell its output externally, so they can only make stuff to transfer over, and they have excess capacity. Would the top management of Emerge want the divisions to take the order? Well, if you have excess capacity, and let's see here, an order for 7 planes at $22 million each. Okay, well, looking at this, right, the variable costs of producing these are going to be $3 million if we were to make them in systems plus $11 million, so $14 million total, right? So because of that, $22 million sale price is much higher than that. So yes, we would go ahead and take that. And then how much does each aircraft generate as a positive contribution margin? Well, if the total variable cost is equal to the 3 plus the 11, that's $14, and the sale price is 22, that means that the contribution margin is going to be the difference between those two, right? So 22 minus 14, giving us a contribution margin of 8 million. Okay, so they said enter each amount in millions, by the way. All right, now, what range of transfer prices would induce the managers of systems and assembly to take the decision that you identified in requirement 1? Okay, well, for systems division, in that division, then they're going to want to get at least 3 million because that's what their variable cost is per unit. They cannot get less than that. So that's what they would want to get. And then in terms of the assembly division, they would want to at least break even. So the worst price where they would break even would be their, let's see, for assembly division, the manager will not pay more than what would break them even. So if they have $11 million already here, right? So we're going to sell this for 22, and the assembly variable cost is 11. The difference between those two is highest possible supply price that they would pay because they would break even on it. So they would be willing to pay up to 11, which would get them to a net contribution margin of breaking even. Okay, 22 minus 11 assembly, or the 11 at the highest paid for supply would get them to a break even. So it's just a coincidence that that's 11 million, right? Like, let's say if the price was 24 and we had 11 million assembly, then the difference between those two would be, we would be willing to pay supply up to 13, right, to break even if the sale price was 24, right? So just demonstrating that with a different number, so you can see that I'm just taking the difference between those two. Okay. All right. So the appropriate range then for the transfer prices would be between 3 and 11 million. Okay, so now suppose that Systems can sell any navigation systems it makes externally for $4.5 million per unit. Okay, so if it costs them 3 million and they can make 4.5 million on it, and we've got $150,000 per system for external sales. Basically, what that would be, we would be for the supply department, or I'm sorry, systems. I keep saying supply, systems department. We would sell it for 4.5. We have a variable cost currently of 3. And then we would also incur sales costs, so variable sales, which would be minus 0.15 in terms of millions, right? So 150,000 is 0.15 million. So if we look at that, where we would end up being here would be a sum of 1.35 million net for the systems if we were to do that. Okay. So would we take that order if we had the capacity? Heck yes, we would. So how much profit in millions do we earn? That would be the 1.35 million. Right. So just showing this, right? 4500000 minus 3000000 minus 150,000 gets us 1,350,000. So just all I did was take the zeros off here. Okay, now, what range of transfer prices would induce the managers of systems and assembly to take the decision that we identified here? All right, well, for systems division, we would need to get, let's see, what we could get for it less the cost of the market price. Like, so if we can sell these to outside parties for that much, then we don't want to sell them internally for less than that much if we had the ability to do so. So like if we could sell everything we make to outside parties for 4.5 million minus that sales price, then let's see. So 4.5 minus 0.15 gets us so netting from the sales 4.35 is essentially what we would get. So we would want the transfer price to be whatever we would get net of the sales costs here. We would give it for less than the 4.5 million because we would not incur that sales cost if we were to sell it internally, right? Now, for the assembly division, the manager would not pay a transfer price higher than what? The market price. The market price is the ceiling. So then that would put a ceiling of 4.5 million on that sale price, or on that transfer price if we were able to do that. So the range then would be between 4.35 and 4.5 million. Okay, so if we have capacity, if we have, especially if we have limited capacity, or if we can sell everything we make, then we do not want to have a transfer price of less than the what we can get for it selling it to somebody else. theoretically, right? Okay. So this then is our last problem here. And the last problem here is going to look through, okay, well, what happens if we were to take taxes into consideration here? Because we've been looking at this strictly theoretically based on just like general profitability without considering the effect of taxes in this equation. And so this is going to, last problem is going to walk through how those, how taxes would influence this. Okay, so we've got Generation Electronics. They're going to make solar panels at their plant in Ohio, so in the US. Variable cost per panel is $90. Okay, so solar panels, Akron, variable cost is $90, and the full manufacturing cost is $250. Okay, so that we can guess here then that the difference is probably a fixed cost. So difference there is $160. Okay, net of marketing and distribution costs. We ship these panels to Madrid, Spain, and Madrid sells them at an average price of $500. Okay, so looking at our tax information here. Okay, so Generation pays 25% tax rate in the US in the Akron. And Spain levels a $30 tax rate on the Madrid division. Both tax authorities only permit transfer prices that are between the full manufacturing costs per unit. Okay, so at minimum, we've got that, right? And let's make that red. I'll highlight it. There we go. Okay, so okay, minimum allowable transfer price based on Spain's laws, and a market price of $375 based on comparable imports into Spain. Okay, so maximum transfer price is $375. Okay. All right, so what transfer price should the generation company select to minimize the company's tax liability? Well, as I mentioned during class, we want to try and maximize the profit in the place where they have the lowest tax rate here. So if we're just looking at this, then what we would want to do is have a transfer price. So legally, the transfer price has to be between that 250 and the 375, right? As Spain has a higher tax rate than the US, Generation's best interest is to maximize profits shown in the US by charging the highest possible transfer price. So then the profits sit in the Akron location if they charge a higher transfer price. So we would then use the $375, which is the maximum allowable transfer price that we can use based on Spain's rules. Otherwise, Spain will only let us take a deduction for the $375. They have fun ways of doing that. So Spain can control what the US company decides to charge for that stuff. Okay, now, in an effort to protect local manufacturers, Spain introduces customs duties on solar panel imports. A 17% customs duty is now levied on the price at which panels are transferred into the country. The duty is a deductible expense for calculating Spanish income for the purposes of income tax. Calculate the after-tax operating income earned by the US and Spanish divisions from transferring 300,000 solar panels at the full manufacturing cost per unit and at the market price of comparable imports. Okay, so begin by calculating the after-tax operating income earned by the US division from transferring 300,000 solar panels at full manufacturing cost per unit. Okay, so if we do this at cost, and it's going to be 300,000 panels, the Akron revenues are going to be the $250 cost times the 300,000 units there. Oh, let's make that wider so we can see that. Okay, and let's add in commas. Oops. $250. Yes, and I'll put the formula in here too, just in case anyone missed that. There we go. Okay, so 75 million. And the full manufacturing cost that we'll be getting charged, which is the 250. All right, so transferring it at cost gives us an operating income of 0 for that division. So it's just a break even. So no income in the US. Okay, now what is the after-tax operating income earned by the Spanish division if we did it at that cost? Okay, well, the Spanish unit is going to sell these at their price of $500,000. So that's going to be 500 times the 300,000. And then, so 150 million. And then the transferred in costs are going to be what they paid for it, which is that 75 million. So here's the cost of transferring it in, 75 million. But there's a 70 or 17% import duty now. Okay. So we got to figure that out. So the import duty is going to be 17% times that transfer price that we had of 75 million. Okay. So 12,750,000. Okay. So I'm going to I'll put a minus there. And then we'll put, okay, so that gets us the, so total costs here are going to be 87,750,000, giving us a divisional operating income of $62,250,000. Okay, and then the income taxes on that are going to be the 30%, 0.3 times that operating income. That gives us 18,675,000 in taxes, which would get us to after-tax income of those two netted against each other. So 43,575,000. Okay, so that's where we end up with if we transfer this at cost. Okay. All right. So, and in total, so we had 0 income over here, and then we had 43,575,000 here. So that's our total income that we had there. All right. So the next thing that they want us to look at then is, okay, well, what happens if we do this and we decide to put a higher transfer price on it? Okay. So what if we transfer them at the market price of comparable imports, which would be, let's see here. Was that the 375? I think it was. Yeah. Just double check. Yeah, I believe so. Okay, so they're going to sell it now, Akron revenues. I'm just going to copy this here and put it, so I've got these totals, only I'm going to edit it. Okay, so here we've got, instead of a $250 transfer price, we're going to have the 375, I believe it was. Yes, 375. Okay. So 112,000, 112,500,000. Our full manufacturing cost is the same, 75 million. So that gets us to income here of, I didn't have to do any math on this before. Okay, so 37,500,000. All right, now we got to figure out what are the taxes here. So the taxes are going to be the, what did we say up here? 25% tax rate. So 0.25 times that amount. So that's going to get us then to 28,125,000. Oops, what did I got a 9,375. Oh, I put a negative and I didn't want a negative in there. That's why. Okay. So that's exactly what I had over here. Okay. Now, the Spanish division is going to have the exact same revenues regardless. It's 150 million. And their transferred in costs then are going to be the increased amount we had up here, which was the 112,500,000. Now, customs duties are going to be, so let's do this. Import duty is going to be that times, so 17%. So, wait. I'm off by a zero here. This would be 1 million. Hold on. 112 million. 500. Yeah, I'm missing a zero there. There we go. That looks better. Okay. 1,000,000, what, 112, 500. Okay, so I typed it over here right. I just didn't put it here right. Good times. Okay, so that gets us customs duties of 19,125,000, netting us oh, okay, I got to make that one negative too. Here we go. Oh, that's negative. Why is that not coming in as negative? The heck? Oh, because I linked it and it's a negative. That's fine. Good times. All right. So 18,375,000. And then that gets us to tax. I already had this coded in 30%. So 5,512,500. And then, whoops, did this wrong. Wrong line. I did put a total division costs on here. Hold on. 131,625,000. Got off on my lines either. There we go. Okay, so ending division income of 12,862,500. Okay, so let's look at this, all right? When we did this before, this is the amount of income that we had, okay? Now we're going to have this income and this after-tax income. The sum of those is 40,987,500. So we're actually overall making less money by having this way because, and why is that? Well, because we're charging all the income here, right? And this has a lower tax rate, but this import duty of 17% is effectively an additional tax on this. If this was lower priced here, then the amount that we're charging the import duty on is significantly less. It's only 75 million instead of 112,000, 112,500,000. So the 17% tax on that additional income basically means that the effective tax rate here is 25 plus 17, actually 42%. When we do that. So in total, our taxes when we have import duties end up being higher overall. So the 30% income tax here would be less than paying the 25% plus the additional 17% of the transfer price here, which is not super intuitive. So you got to run the math on that. So generation's decision changes then with that import customs because they would want to then charge just the full manufacturing cost of 250 because it would overall decrease the amount of taxes that end up getting paid. All right, so that is it for transfer pricing.